And I'll go back to the Fed staff forecast yet again, that if their forecast is to be believed, that's a greater likelihood of seeing 3.8 on the 10-year note within the year than seeing 5.2. And you get to 3.8 because of the convexity, you'll make 10% total return.
Well, hello everyone, and today I have a very special guest on the channel. This is Dave Rosenberg, president of Rosenberg Research. He's the former chief economist at Merrill Lynch and Glidden Chef, and he's consistently won acclaimed awards in the All-Star Institutional Investor Analyst Rankings. It's a pleasure to have him today on the channel. Dave, how are you doing today?
Fine, thanks, Larry, and I hope you are too.
Excellent. So we've got a lot of really great questions for you today related to the economy, the macro, the markets. Let's get straight into it. So I've seen a lot of your work on Twitter, and you've consistently warned that a U.S. recession is not a matter of if, but when. And what signals are most convincing to you right now that a downturn is imminent or underway?
Well, there's different ways you can unpack that. Of course, calling for a recession is never an easy task. And of course, there were several of us that thought we were going to get a recession in 2022 or 2023 in the aftermath of that Volcker-esque type of tightening policy that Jay Powell put into the system. I think what a lot of us missed was the dramatic fiscal stimulus that we were going to see that was a super strong antidote. And of course, those $2 trillion of pandemic related stimulus checks was a gift that kept on giving, and all of it got spent, which is unprecedented. And that thwarted the recession call, but here we are in 2025, and it's a totally different kettle of fish. The things I'm looking at are what the Fed refers to as the soft data. And the Fed is waiting for the soft data to morph into the hard data. Hard data being retail sales, employment, GDP, industrial production, so on and so forth. The soft data is surveys. And the thing about surveys is that they tell you something about patterns of behavior, both current and in the future, in the household and business sector. When you look at the non-farm payroll number and everybody trades off of it, it doesn't tell you about the veracity of that number. It doesn't tell you about the quality of the jobs being created, or what's happening to the work week, or the length of time that the current stock of unemployed, the difficulty they're having in finding a job. Those are just hard numbers. That's why they're called the hard data. But they don't tell you anything about behavior. But when you take a look at the survey data, which is again the soft data, and there's a plethora of high-frequency survey data coming out of the business sector and coming out of the household sector. And actually, when we amalgamate all these soft survey data, they are actually consistent with GDP. Not a +1, not a +2, but actually minus 1.3. And the Fed is deliberately waiting for that data to happen. Will the soft data lead the hard data? And so that's what I'm looking at, and not just the current soft data, but all these different measures. Whether you look at the Conference Board or the University of Michigan's consumer sentiment surveys, they have a lot of forward-looking elements to it, asking people, what do you plan on doing in the next 6 to 12 months? How do you see the job picture unfolding in the next 6 to 12 months? What is your intention to buy a home, to buy an appliance, to buy a car, to go on vacation? It gives you a good forward-looking feel as to not what's just happening now, but what's happening around the bend. And the same thing in these CEO or CFO survey data. It's not just how are you feeling today, and I'll be the first to say that feelings don't go into GDP. GDP is a hard data. But it's asking how are you feeling today, and then how are you feeling? How are you feeling as a CEO about your hiring plans and your capital spending intentions over the next 6 to 12 months? And none of these are perfect. And there's no such thing as a surefire call, even a recession call. However, these soft data reports are signaling that the chances of a recession are definitely over 50-50, that they are a base case scenario, not a surefire case, but in the realm of forecasting and in the realm of investing, it's always about how probabilities are shifting over time. And the one other thing that really caught my eye was the latest set of FOMC minutes that came out for the May meeting. And this just got released. And what it showed, and this was, I think, rather alarming and got very little attention in the business and financial media, was that the Fed staff economists, and they always lead off in these FOMC minutes, they lead off with the Fed staff view of the economy, and then they go into what the participants, the actual policy officials, had to say. So what did the Fed staff say? They said, even as they downgraded their economic growth projections for this year, they had the temerity to say that the risk of recession is equal to their base case forecast, a base case forecast that they just cut. Now, I look around, and I'm looking at the equity market, I'm looking at the credit market, I'm looking at the Treasury market. I don't see anything remotely priced halfway for a recession. Not even close. But what else came out of the Fed staff view, and I'm not going to say it's gospel, it's just that obviously the Fed staff economists have access to models that the rest of us mere mortals don't have at our disposal. But they said that the output gap, which is the measure of excess capacity in the broad economy, in the product market and in the labor market, that output gap, that excess capacity, is going to widen not just this year, not just next year, but into 2027. And that is basically code for what? For a higher unemployment rate. And keep in mind that the peak unemployment rate in the FOMC forecast for this year is 4.4%. We're now at 4.2%. And the Fed staff forecasts are saying we're going to go above what's called the natural rate of unemployment, which means that we're going to blow a hole through that 4.4% projection by these interest rate decision makers. Now, I would say that if I was on the FOMC and I believed my own staff's forecast, I probably would have cut rates that meeting. But they didn't, and the Fed continues to signal that they're going to stay on hold indefinitely. And I think the message is that we are going to be on hold until we see the whites of the eyes of the recession, until we actually start to see employment go down. The problem there is by the time employment goes down, it's too late. So the other aspect of this, of course, is what does it mean when you have widening excess capacity in any economy? It puts downward pressure on inflation. It puts downward pressure on pricing power. It is not bullish for corporate profits, quite the opposite. So when I look at the Fed staff forecast, and like I said, I'm not saying it's gospel, but you have to give it some serious consideration. And I was on the asset mix committee of a mutual fund. I would be saying we have to shift right now from stocks and into bonds. That was the message from those FOMC minutes that just came out.
Okay, so as of right now, you basically think that the stock market is in a state of denial, that nothing really is priced in terms of recession risk. What do you think is making investors so comfortable to bid the indices up to these recent highs?
Well, I think it's because of the way you asked the question as you answered the question. It's that the market is in denial. The market believes that the economy is recession-proof. And I think that view was emboldened by the fact that here we had the Fed take interest rates up more than 500 basis points in short order, and the economy just smooth sailing. So I think that there is this level of hubris, this level of complacency, this level of confidence that's going to be tough to shake. So that's the explanation. And I'm not going to say that the stock market is exuberant. I'm going to say that I have a different view than the stock market. The stock market really has a consensus view. The consensus economics view is that the economy will be slow but will not contract. And if you look at the analysts that make the forecasts for earnings, they're basing that off the consensus economics community. And that's what these stock market participants look at. They're looking at the consensus view. I don't have the consensus view,
Right.
but that explains why the stock market's behaving as it's behaving over the course of the past several months.
Right. A recent breaking development is that the U.S. Trade Court is trying to block Trump's reciprocal tariffs. What are your views on this?
I think it goes even beyond that. I think it's also the baseline tariffs. There's some exceptions to some industries like auto, steel, aluminum, pharmaceuticals, lumber, semiconductors. So it's not 100% sweeping, but you're right. It has basically taken the global trade war off the table. Now, of course, the White House is going to challenge this to the Supreme Court. I have a tough time believing the Supreme Court will rule against the U.S. International Trade Court. It was unanimous, 3 judges. One of them was appointed by Donald Trump in 2018. That basically he went beyond his authority in this really broadly based imposition of all these tariffs. Now, I guess the way I see it, because the market reaction has been fairly muted, then again, we were up 18% from the April lows, and we've had a 3 multiple point expansion from 18 to 21 in the forward PE multiple. So the market is no longer oversold. You could argue that it could even be overbought right now. But what happened is that on April the 9th, we had the reprieve on the reciprocals. And then I think you go to May 12th, and we had the reprieve on China. And then you go to just this past week, and we had the reprieve on the EU. So I think the markets were increasingly getting comfortable with this view that this was part of the art of the deal, that Trump was never going to tip the global economy into a 1930s type of trade war, that this was all a ploy to get countries to the table to negotiate deals with the United States. And so that's why I think that the reaction right now is muted. We've certainly taken out a worst case scenario, maybe a disaster scenario, when you look and you see what was being proposed back on April 2nd on Liberation Day, to which I was saying, liberate us from our sanity, I suppose. But everything has been walked back ever since, even including Canada and Mexico. So I think over the course of the past few months, I think people were just thinking, okay, this is all part of the art of the deal, and these tariffs that were being threatened are not going to live to see the light of day. And here we get the really big news, which is that it's not even legal in any event, or large parts of it. The flip side is, I think the reason why the markets were so giddy was not just because of the reprieves, but the quid pro quo for the reprieves was that these countries were going to do deals. We're going to have trillions of dollars of investment flows into the U.S. economy, that there was going to be a big breakdown in trade barriers, both in goods and services, that were going to be extremely positive for the U.S. economy. Well, now the question becomes, what happens to those? Now, all of a sudden, if you're not scared anymore by the Trump tariff threat, what's your incentive to do any of these deals that in the end were supposed to only benefit the U.S. economy? So that's why you're seeing some second guessing in the market now, as to basically just how bullish is this? Like, we had the big leg up, the 18% leg up in the market because of the reprieves. But the reprieves were contingent on deals. Well, all of a sudden you got this court decision, and maybe you're not going to get these deals. So, it's not clear, actually, for the risk on trade, for the equity trade, just how bullish this court decision really was when you look at it in that context.
Right. So with the worst case scenario, like you mentioned, global trade war now off the table. In other words, the black swan risk, okay, that has somewhat been cut off. At today's prices for the S&P 500, the NASDAQ 100, you still think, even if the trade war is gone, you think that these levels are poor risk reward?
Well, it's just the math doesn't add up for me. They say that in the land of the blind, the one-eyed man is king. So this is all basically about relative value.
Okay.
You have a 21 multiple on the S&P 500, really at the upper end of the historical range.
Yeah.
What does it mean? It means that the earnings yield in the S&P 500 is 4.6%. But the yield that you get in the 10-year Treasury note is 4.5%. So when you get this situation where the competing yields between the S&P 500 and the 10-year T-note are comparable, it's the investor way of telling me, that the stock market is as riskless as the bond market. And you could talk about your concerns about the bond market. The bond market has duration risk, it has inflation risk, but the Treasury market does not have capital risk. The stock market has capital risk. The Treasury market, you have guaranteed payment of your coupon. That doesn't exist in the stock market. Companies can cut their dividend. And in the Treasury market, whether it's over 3 years, 5 years, 10 years, you know exactly what you're getting upon maturity. Bonds mature. Equities don't. So they're totally different risk characteristics. And that's true whether or not the bond market goes into a bull market or a bear market. When the equity risk premium is basically close to zero, I become a spectator for the most part when it comes to the stock market. So that's the way that I'm looking at the situation. It made sense when you had a 21 multiple on the S&P 500. For example, back in 2020, 2021, and you had that 4.6% earnings yield, the yield on the competing 10-year Treasury note was like 1%. Extremely bullish in a relative trade for equities. Back then, all we talked about was TINA. There is no alternative. And no matter what your view is on the stock market today, and you could be bullish, but you cannot say TINA any longer because there are alternatives. Genie Mae coupons, alternative. Corporate bonds, all the way out to triple B. Great alternatives. The yield, not the spread. Treasuries, great alternative. In fact, cash at 4.4%. The last time, or when we had these multiples in the stock market, when there was TINA, cash gave you zero. Cash was trash. But you can own the front end of the curve or bills for 4.4% at a time when the earnings yield on the stock market is 4.6%. So there are alternatives out there, competing alternatives. And frankly, right now, I think we're at a turning point in the cycle. I do not think we're back in the second half of 2020 or 2021 or 2022 or 2023 when you had these monetary and fiscal policy tailwinds. Fiscal policy is heading towards restraint. We're probably not going to fall off the fiscal cliff as those 2017 tax relief measures get extended in this big, beautiful bill. But that's not the same as policy stimulus. When you add it all up, there's going to be fiscal policy restraint for several years to come. Even as the deficit goes up, the impact on the economy will be negative, not positive. People don't realize that. Most economists don't even realize that. And the Fed is keeping monetary policy deliberately tight. This is a totally different, even beyond, over and beyond the trade war. And now hopefully that's going to subside. But you have these other constraints on the economy. One thing we didn't bring up was, what about immigration rules? What about immigration rules? All people talked about was the booming illegal immigration file boosting the economy. People were bragging about it. I was getting client mail saying, you're not bullish enough on housing because of I had clients asking me to try and estimate the illegal immigration impact on economic growth because, of course, these people work, most of them, and these people spend. Mm-hmm. You're an illegal immigrant in the U.S. economy. You shouldn't be here. But you're spending money. That's showing up in GDP.
Yes, you are.
That's showing up in retail sales. Well, now people don't realize that the impact of these immigration restrictions, which from a society standpoint you can justify, from an economic standpoint, that is going to be a negative 0.4% average annual drainage on spending growth in the U.S. economy. And you got negative 0.5% from fiscal. And then you got negative 0.1 from the end of the student debt moratorium. That's about a full percentage point per year drag. Where's the offset going to come from? We'll get some offset from AI and these data center construction and all the spin-offs, but it won't be enough. And the run rate on real GDP growth right now is only 2%. When I tell people the run rate on the U.S. GDP is 2%, they don't believe me. I have to show them the numbers. They still think we're 2 years ago when it was 3 to 4%. No.
Right.
We slowed down quite a bit.
Yeah.
And the slowdown isn't over yet.
So Dave, you mentioned multiple 21x for the stock market right now. Earnings yield too similar to the 10-year yield. What valuation multiple would make you more comfortable with a larger asset allocation to stocks? Are you looking at 19 times earnings, 18 times earnings? What range?
Well, it would depend. I would say it could be 18 or 19 if the 10-year Treasury note is 3 to 3.5%. Tell me where's the risk-free rate in relation? You can't just say, oh, well, I'm going to love the market at 18 or love the market at 17. Where is the risk-free rate in that environment? Like I said, there was a time and place when a 21 multiple was perfectly appropriate and very bullish when rates were 1% or lower. Yeah. We're not there right now. So it's a matter of doing the math yourself and looking at where the competing yields are, where the risk-free rate is, and then making the assessment of what your comfort level is on the forward P multiple.
Yeah. Let's talk about asset allocation. So given all your views on the stock market, the bond market, where GDP is heading, how would you construct, say, asset allocation for, like you mentioned, a mutual fund? How would you divvy up stocks, bonds, commodities, maybe even cryptocurrency, if any?
Well, they talk about 60-40.
Yep.
And I talk about 40-60.
Okay.
I'd want to be, I think the bond market, the treasury market's become a high yield market on an international basis.
Okay.
And I don't believe, notwithstanding the credit downgrade, the U.S. is not becoming the banana republic. I think that a lot of the reason why treasury yields are where they are is because the Fed is pitting the policy rate, between 4 and 4.25%. We have to wait for the Fed to start to dramatically reduce the cost of carry, steepen the yield curve, and the longer the Fed waits in this economic environment, the more they're going to have to do. That's why I'm bullish on bonds. I think that the Fed eased last year. They've gone on hold. They've gone on hold for too long, in my opinion, for two reasons. They still are viewing, the two words, elevated uncertainty. That is the crutch for we're not going to do anything. And then, of course, you had John Williams, the head of the New York Fed, talk about how inflation expectations are higher because of the pandemic. Well, sorry, the pandemic is in the rearview mirror, and there's not a whole lot of evidence that inflation expectations or wage expectations are becoming unhinged. But the Fed is almost locked in a box. The memory bank, the horrible experience of calling for transitory and missing it, and then we had 18 months of really a very bad inflationary outcome with Jay Powell's term ending in May of next year. He doesn't want to go down as being compared to Arthur Burns. Arthur Burns, by the way, was a brilliant economist, but when you think of Arthur Burns in Wall Street, you think of inflation. He wants to go down as Volcker. He doesn't want to go down. He's got a year left before he's no longer chairman. He doesn't want to, he's going to be remembered as the low inflation guy, and that people will not remember what happened in 2022 and 2023. And I think that is going to sow the seeds. It already has. The Fed is too tight right now. At some point, they'll cut rates aggressively. The whole curve comes down. And I think that you'll probably make 10% in the 10-year Treasury note in the next 12 months. So I don't think you'll make 10% in the stock market. But I think that you'll make more money in the bond market straight up and risk adjusted. So I like treasuries over equities. And I think that I would continue to do what I've been saying to do for some time, which is diversify into other markets. If you love the U.S. market, and a lot of people do, well, Canada, although we hate to say it in Canada, we are the 51st state. It doesn't actually play very well at cocktail parties. But the Canadian market trades at far cheaper valuations. They compete with far lower bond yields, has much stronger dividend growth and dividend yield characteristics, and you're investing in a very cheap currency. I like the Canadian market relative to the U.S. market. I've been saying that for some time. Europe looks very good to me right now. Europe, they're taking off the fiscal straitjacket, and the energy tourniquet that they were suffering a few years ago has loosened. The ECB is cutting rates. The Fed's the only central bank not cutting rates. But the ECB is cutting rates, and you got more visibility there in the earnings side than you have in the United States. I like the diversification into Europe, and not just Western Europe, but the Eastern Europe stock markets. Nobody talks about Poland or Hungary or Czechoslovakia or Romania. They've done exceptionally well this year. And so that's a part of the world. It's not the Wild West. It's not emerging markets. The European market trades at better valuations. Like Canada, competes with much lower interest rates and has a modicum of earnings visibility. And so I like the European market. When you're talking about the segment that you want to be in equities, I say, branch out beyond the home country and think of Europe. It's I had been quite a bit bullish on Asia for some time, but Europe has overtaken that. Europe has become our favorite foreign destination for capital. And then you have to look at within sectors, because you asked me about the stock market, but the question is, what is the appropriate beta of your portfolio? What's the risk profile of your equity portfolio? That tranche that's in stocks, I would suggest, because I believe that we're at a turning point in the economic cycle. I do believe that the Fed staff models are going to get it right this time. And therefore, I want to be very defensive. And I'm not saying to be zero equities. I don't believe in zero. I don't believe in 100. Everything in the markets are just different shades of gray. But it's all about shifting probabilities. The probability of a recession has not gone away, with or without this trade war. And don't forget, there will still be lingering trade frictions. Not everything is off the table. And Donald Trump will not go down without a fight on this. And we'll see how creative he's going to get if he wants to pursue other avenues to pursue his dream of rebalancing and reshaping global trade. But I want to be in areas that are defensive. In other words, within the stock market, buy what you need. Don't buy what you want. Treat the stock market like your life.
Consumer staples, not
so staples, right. And I'm thinking food products, and they behave very well. Now, you don't need tobacco, and probably shouldn't use tobacco, but tobacco stocks with their dividend growth, dividend yield, I know that a lot of people don't like that. I would say that you mentioned utilities. If I'm right on my interest rate call, I think real estate REITs will be a good place to park your money. And as the yield curve steepens, I think the big banks will be fine. I would say that my two biggest calls are these: global, not just US, but global aerospace defense, because military budgets are going up everywhere, and that's not going to stop. And if you look at the latest U.S. data on aerospace and defense, production, shipments, and most importantly, order books, which have swelled more than 20% on a year-over-year basis, that's an area that there is tremendous visibility and secular growth. So aerospace defense, and I'd say that in a world of heightened uncertainty, domestic political uncertainty, geopolitical uncertainty, diversification out of the US dollar, what's the best hedge? Gold, physical gold, still very bullish on physical gold, and I would say the gold mining stocks, where you should really go into Canada, where at least you can get a bundle of gold mining companies that are trading still at very steep discounts to the underlying commodity price. So there you have a nice little portfolio. Because I'm not telling anybody to go out and buy canned tuna, barbed wire, sawed-off shotguns, or even have to have a lot of cash. Not that I mind cash at 4.4%. You should probably have some. You get paid for it, and you have optionality. But I do like treasuries. I do like aerospace defense, gold, physical gold, gold mining stocks, consumer staples, as you mentioned. Start scaling into the REITs because you want to own what I call bonds and drag in the stock market. As bonds rally, you want to own the parts of the stock market that are most correlated with declining long-term interest rates. That's probably my most controversial call because everybody hates the bond market. But you see, Larry, I am a natural-born contrarian. I do not go with the herd. I do not go with the consensus. I will say once again, if the Fed staff forecast is anywhere close to being on the mark, you wish that you owned bonds which are now maligned, detested, and ridiculed, and you want to own the areas of the stock market that are correlated with lower bond yields.
Right.
And for the next year, you will be just fine.
Yeah. So, let's just say this view is going to play out. In this case, where do you see the 10-year Treasury yield, say, by year end? And what's the best ETF to take advantage of this view? Is it the TLT ETF? Is it the 30-year long duration bond ETF? I believe it's UTHY. What do you...
I'd say either of those are just fine. I think the TLT probably is more has longer duration, or you can just buy you don't have to buy the ETF. Just go and buy the 10-year note. Call your dealer and buy the 10-year note straight up, or the 5-year. Where do we end up? I think we'll finish the year below 4% on the 10-year note. People say below 4%. Are you kidding?
That's very possible.
We were just last fall we were 3.6.
Yeah.
This is again what people have to understand about the bond market is convexity. That if yields go down, not only you're clipping a good coupon if you get in at the right time, but you get the price appreciation. You get the capital gain on the bond. The bond, when yields go down, the bond you're holding becomes more valuable.
Yep.
So let's again take a look at the distribution curve or the probability curve. When we had, say, back in 2020, the 10-year note at one point, believe it or not, was 0.5%. You had no coupon protection whatsoever. All you needed was to have a 6 basis point increase in the 10-year Treasury note yield, and you were already heading into negative return territory. And of course, we had a couple of years like that. And then everybody said, well, bonds are for losers, and the 60-40 SI mix is a stupid concept. To which I say, Harry Markowitz won a Nobel Prize for a reason. But it was just that bond yields were stupid low for too long. And as an investor, you had no coupon protection. Mm-hmm. It only took a small increase in yields to generate negative returns. You never expect to get negative returns in the bond market. They're supposed to be these stodgy, non-sexy, reliable, but when yields are that low,
there's no cushion.
It doesn't take much. And look what happened. We had a couple of years of negative returns in bonds. But that was then, and this is now. And now you're 5% on the long bond, you're 4.5% on the 10-year note. What would it take now at today's starting point on the yield to start losing money again in the Treasury market? Well, the 10-year note would have to go to 5.2. We'd have to go up 70 basis points. We would have to break above the October 2023 cycle high. Now, maybe you and I can sit down and devise scenarios where that's going to happen, but that, to me, would be a very low odds event. Well, let's finish drawing the probability curve. What if the yield goes down 70 basis points and not up 70 basis points? And I'll go back to the Fed staff forecast yet again. That if their forecast is to be believed, that's a greater likelihood of seeing 3.8 on the 10-year note within the year than seeing
5.2.
5.2.
Yeah.
And you get to 3.8 because of the convexity, you'll make 10% total return in the 10-year Treasury note. You will make an equity-like return without having
the risk
equity
adjusted
risk.
return is better. Like,
And actually, that's a trade-off I like quite a bit.
Excellent insights. Dave, where can our viewers find more information about you?
Well, I would suggest that if you come on the website, you can check us out. Just Google Rosenberg Research, or you can go to information at rosenbergresearch.com. Click on one of our client service individuals will get you a promo code for you to come on. And for everybody on this call that's viewing this interview with you, Larry, everybody who comes on will get a 1-month free trial of everything that I do, so you can kick our tires. I always like for people to be able to, taste my food before they buy the banquet. So I encourage people to do that. Anybody who wants to reach out to me personally, I will not give out my phone number because that's maybe a little too personal. But you can also reach me at Rosenberg at rosenbergresearch.com.
Excellent. All right. So everybody, rosenbergresearch.com, 1 month free trial to all of Dave's insights. He's looking to protect your portfolio for what's coming up ahead. And if his forecast is right, I personally do believe that a 3.8% print on the 10-year Treasury is very likely to happen. Dave, thank you so much for being on the channel. And when the Fed does start cutting later this year, we'd love to have you back on the channel to discuss your views on the state of the market at that time.
I would be most happy to do so.